Good afternoon and welcome, everyone. My name is Mark Bradford, and I'm the head of wealth planning for Bryn Mawr Trust. Today, I'm joined by one of our planners from Bryn Mawr, Jeff Kitchen. Jeff is a certified financial planner, much like myself. He is also a national Social Security advisor with deep expertise around Social Security and retirement income planning. Today, we are going to talk about simplifying Social Security. We'll spend some time understanding benefit calculations and how to optimize benefits, when to strategically claim benefits for maximum benefit, talk a little bit about tax efficient strategies with regards to retirement income, and then we're going to talk just a little bit about the challenges facing Social Security and some potential legislative changes that we may see. We'll also try to get to many of the questions that were submitted during the registration process at the end of today's presentation. However, to kick things off, Jeff, when we think about Social Security, most people equate Social Security with retirement. But it's really much broader than that. And I'd love to have you just start at a 50,000-foot view for us and talk a little bit more about what Social Security is, so that people have a better understanding of everything that it covers and who it benefits.
Of course, Mark. And of course, good afternoon, everyone. Thank you for being here at this webinar surrounding Social Security. And Mark, I completely agree with you. When we think of Social Security, we think of mainly retirement benefits, but Social Security is far more than just a retirement program. It is quite literally a federal insurance program with the original name Old Age and Survivor Disability Insurance Program. And it seeks to, of course, help and support retirees with 10 years of work experience as early as age 62. However, it also supports disabled individuals and survivors of those workers. Lastly, Social Security also supports other family members, such as disabled children and even divorced spouses. Now, Social Security started as a sole retirement benefit, but as time has went on, dependents and survivors were added, disabled workers were added, and the program had spread out and truly, again, moved from more of a retirement benefit solely to a full federal insurance program.
It's quite a lot of benefits that Social Security pays out. Jeff, can you talk just a little bit maybe about how it's funded? And
of course, Mark. Of course, yes. Main funding source for Social Security, and this will give a lot of insight into sort of the inner workings of it, but the main source are FICA taxes, and FICA stands for Federal Insurance Contributions Act. FICA taxes are otherwise known as just our payroll taxes. So when we get paid, they're automatically withheld from our paycheck, and we kind of don't really notice it or think about it, but it is a 6.2% withholding on your earnings, plus a 1.45% withholding for Medicare. So the 6.2 is fed into the Social Security Trust Fund, and the 1.45% pays Medicare expenses. Now, I'll tell you that your employer is also making these same withholdings. Now, this money funnels into the Social Security Trust Fund. It is invested in government securities, and then that money is paid out to, of course, retirees, disabled individuals, and survivors, et cetera. Now, the issue we're running into is that we have so many of these individuals under those categories pulling from the trust fund that now we are facing a depletion issue and a lack of funding overall.
Yeah, and I know we're going to spend a lot of time talking about the solvency issues related to Social Security, but maybe it'd be helpful for people if you talked a little bit about Social Security as it was when it was established and where we are today.
Certainly, Mark. Yes, Social Security has changed drastically since its inception way back in 1935. And if you think about it, I always kind of think, oh, we've been through so many geopolitical events and economic environments, and Social Security has sort of been that constant, and it's stuck around. Now, if we jump back to when Social Security began in the 1930s, the world looked very different, to say the least. The average life expectancy was, believe it or not, under 60 years old. So that being said, many people never even lived to collect Social Security benefits, period. And those benefits initially were really only meant to be an income supplement, not actually an income replacement or a foundation of retirement income. Now, the actual financing looked a little different as well. The worker to retiree ratio at that time was 160 to 1. So there were far less retirees pulling from the system than there are today. Back then, benefits paid out in the first couple of years only amounted to about $1.7 million. And compared to now, that is a significantly lesser amount. Now, I'll also say, and it's important for us to realize the context, the 1930s, what was going on, the Great Depression, and poverty rates among seniors skyrocketed to nearly 50%. And given pensions weren't exactly a thing yet, retirement plans and employer plans were not, families relied heavily on multi-generational support to help these seniors, and also additional savings were needed on top of that. Now, if we jump to today, the average life expectancy, as we know, has jumped up to 78 to 80 years of age. But that also tells us that individuals are spending 20, maybe even 30, maybe 35 years in retirement. And it can be easily said that people can outlive their retirement savings. Now, if we look at how Social Security supplements income, Social Security more so covers close to 40% of an average retiree's income, which is a substantial increase from its original intention. The workforce has also changed as well. Now, the current worker to retiree ratio is 2.8 to 1, which again further shows that point that there are so many less workers per retirees and so many more retirees, of course, mainly from the baby boomer generation. Now, I'll also say that at the same time, of course, just this year, $1.4 trillion in benefits were paid. At the same time, retirees actually have gotten better, and the original intention of the Social Security system has been successful. The poverty rate has dropped from nearly 50% to 9.5%, which is thankfully due to, of course, mainly the Social Security system and other factors. But another thing to consider is that retirement plans now help close that gap and put a lot of that savings responsibility on the actual employee. But yes, Mark, to say the least, Social Security has changed immensely.
Really great commentary on then and now. I think one of the points to drive home here is that life expectancy piece. Jeff, for many times we get asked, when should I claim benefits? Does it make sense to take delayed retirement credits and wait till age 70? And we're going to talk a little bit more about the filing strategies. But if you think about mortality and the fact that health could come into play, and the average life expectancy is late 70s to 80, waiting for benefits may not necessarily be on the table for somebody if health is an issue.
Oh, exactly.
Go ahead, Jeff. I'm sorry.
No, I was going to say, I completely agree with you. Longevity is probably like the biggest thing to consider when it comes to taking Social Security, because you want to make sure you live to actually benefit from taking later, essentially. So agree with you there.
Absolutely. Well, Jeff, let's shift gears and talk just a little bit about how benefits are calculated and when they begin.
Sure. I thought it would be easiest to first lay out two definitions. Firstly, full retirement age, or FRA. Now, full retirement age is the age upon which you receive essentially 100% of your Social Security benefits. And this 100% number is referred to as your primary insured amount, or your PIA. So it can be said that at age 67 or at your full retirement age, you would receive your PIA, or 100% of your Social Security benefits, as people commonly refer to it as. So age 67, you get your full benefit if you were born after 1960. Prior to that, you're somewhere in between age 66 and 67. Now, if you claim Social Security as early as age 62, you would experience a 30% permanent reduction in benefits. And that is, again, permanent. So once it starts, that's going to be your benefit moving forward. Now, the latest you can delay is until age 70. And now it's sort of the flip side. You delay a couple extra years, you actually get an 8% increase each year, believe it or not. And we refer to this as a delayed retirement credit. Now,
Significant.
I no, I agree, Mark. It's very significant, and we'll talk about some strategies where it might make sense later on in the presentation. Now, I'll also say that the spousal and survivor benefits can be protected, excuse me, potentially affected if you are maybe a younger spouse and you are collecting spousal benefits early, they could potentially be reduced. Or on the flip side, again, we mentioned the increase if you're a survivor and you or excuse me, if you're a worker, you work a couple extra years, and then your survivor can potentially benefit from those increased amounts there. But what age to begin benefits is the key question here, and it's important because once you make that decision, you're sort of locked into those either permanent increases or decreases.
Yeah, lots of different considerations there when you think about when to take benefits, and we'll try to sum that up at the end. But nice coverage there. Moving on to benefits, how they're calculated.
Of course, I'll try to keep this one brief. I know calculations are a little bit dry to look at, but Social Security taxation, or excuse me, calculation is actually pretty straightforward. So firstly, we are getting all of our FICA wages. So you'll remember I mentioned that you can be taxed up to $184,500 for FICA purposes. So we're taking all those numbers each year, adjusting them for inflation. We're going to add them all together. We're going to divide it by 35 years and then 12 months, or effectively 420. And then we're going to come to a number which is called our AMI, or our average index monthly earnings. So of course, our average amount that we've earned, indexed for inflation. We're then going to apply a bend point calculation to get to our PIA, our primary insured amount, or our essentially 100% benefit. So we apply 90% of the first 1286 of our AMI, 32% over that, and then 15% over any number over 7,749. And one of the main points I'll drive home here is that this is a progressive formula. So it seeks to supplement a larger amount of a low earner's income than a smaller amount of a high earner's income. So that's an important point to drive home here.
Jeff, can you just elaborate a little bit more on primary insurance amount? I think you had said it was the full benefit.
Yes, exactly. It's the full benefit that a Social Security beneficiary should anticipate at age 67. So I always say 100% because that's what I hear people refer to it as, like, oh, when's the age I'm going to get my full benefit? So 100% is age 67.
Thanks for clarifying that. So
Sure.
Social Security used to send out all of these statements to individuals in the mail to give people an idea what their benefits look like. And things have changed a little bit. The statements still exist. We're going to go in and we're going to review a statement in just a moment. Could you just talk a little bit about when people can expect to see them and when they should go to the government website to get them?
Sure. Yeah. Things have definitely changed, especially since COVID. So really the big change here is that previously everyone age 60 or older would receive a statement in the mail. Now, that is not the case. If you're over age 60, if you are not collecting benefits yet, and you do not have a Social Security online login, that's the only, if you satisfy all three of those, that's the only instance where you'd actually receive the mail-in statement now, believe it or not. It's really on the retiree or you to go onto the Social Security website, create a login, and file through that way. But again, that's really first off a good place to start. I highly recommend everyone sign up for a Social Security website login, as that's where you'll be able to get those benefit estimates to further help with your planning scenarios.
Excellent. Well, let's take a look at a statement, and the website for people's edification is ssa.gov. So certainly make sure to go on and register. Jeff, talk to us a little bit about what we should be looking for when we talk about benefits and the statement.
Of course. Now, this is of course, sample Social Security statement. It's going to discuss really benefit amounts and then also eligibility for those benefits. First, on the top left-hand side, you'll notice retirement benefits. This is where you'll be able to see if you have satisfied that 40 quarters of credits or 10 years of work experience to even be eligible for retirement benefits. On the right of that, we have our estimates for our retirement benefits, of course, starting at age 62, going on to age 70, and then each sequential year, you can see the increasing amount. On the left-hand side, we can see our disability benefits, and some guidance can be found regarding that on the SSA.gov disability website. However, that gives you the number for that. Survivor benefits right under there are also a critical point on this page. It gives you insight into, of course, spouses caring for minor children or even just minor children. And then on the right-hand side, it shows eligibility for Medicare as well. And I highly suggest going onto the Medicare.gov website. That's a very, very helpful resource, as I know many of us are navigating that Medicare situation as well.
Yeah. And Jeff, before we move on, there are a couple points I just want to accentuate here. Disability benefits, it is important to point out that qualifying for disability benefits is not the easiest. The definition is pretty much any gainful employment for the most part, and that may not be what you were doing before. So it is a pretty strict definition. The other thing to point out, we talk a little bit about what a delayed retirement benefits look like. If you look at this sample, you can see the flows and the benefits starting at 62, and then how it increases, to Jeff's earlier point, with the delayed retirement benefits at age 70. It is a pretty significant difference based on this sample case. But once again, it's a permanent election. Survivor benefits definitely come into play, health of individuals, and so on. Jeff, let's flip to the backside of the statement and see what that looks like.
The backside has a couple of other great points of information here. Firstly, the earnings record. You'll see that on the left side. I highly recommend you look at your earnings statement. Sometimes the Social Security Administration doesn't pick up on all the wages or earnings each year. So I highly recommend reviewing this list on the left-hand side, as if you did pay more into the system one year, you may potentially have higher benefits. So it could potentially be an advantage. On the right-hand side, we have more information about Social Security, including where to go to get your Social Security estimate. And then below that, there is some more guidance around divorced spouses and their benefits as they're eligible for benefits. And then right below that, there's some guidance around pensions. Previously, pensioners would essentially have their benefits reduced while collecting a pension, and now that is no more. So if you have a pension, that's some guidance surrounding that as well. But again, right-hand side really has a bunch of important things and other planning considerations.
So Jeff, you talked a little bit about the pension and the offset there. Can you just maybe elaborate on spousal benefits? Because we get lots of questions on what that looks like, especially if you have different earning spouses, a high income earner and a lower wage earner.
Yes, a lot has changed in the last 10 years, and I hear a lot of the same the strategies going around. So something was introduced called deem filing, which really just means that when you're applying for spousal benefits, you're applying for your own benefits as well. And there used to be a strategy where you could file for spousal and then switch to your own, and that's not exactly a thing anymore. So that's one strategy, and we'll probably touch on it again. But spousal benefits themselves, a younger spouse is potentially eligible for up to 50% of the worker's primary insurance amount at age 67. However, you have to keep in mind that the spouse needs to wait until age 67 in order to get that full amount. Now, the older spouse must have begun benefits as well. So that's another thing to consider there.
That's helpful. One of the other key considerations there on the back of the statement was we're referring to divorced situations. Can you just elaborate on that's what happens there?
Yeah, of course. So individuals need to be really married for 10 years for the divorce benefits, and then they cannot get remarried after the age of 60. So those are really the two big stipulations there. But to conclude your question, yeah, the divorced spouses can receive a benefit, and there's some good guidance on the statement as well.
Okay, excellent. Appreciate it, Jeff.
Sure.
We're going to hop into some other key considerations when you're talking about claiming benefits. But before we do, I also want to highlight the fact that COLA was in there in that column as an update at 2.8%.
Okay.
It started in January for this year. So just a quick update on that. When claiming, one of the things that also becomes a key consideration is whether you're employed, whether you're still working. And if you're still working, it's important to understand that there's an annual earnings test that comes into play. That is all wages and net profits, if you're self-employed, that get taken into account and applied against this earnings test. So if you're younger than the full retirement age, then the earnings threshold is 24,480. So it's pretty low for a recipient. And for every $2 over that limit, $1 in benefit gets withheld. When you reach the year of full retirement age, that threshold pops up to $65,000 a year. And it's for every $3 over that threshold, $1 in benefit gets withheld. And then once you reach the month of full retirement age, there's no limit on earnings. What's important here is the fact that it is not, you're not losing it. There is a recalculation that takes place on those withhold benefits. So certainly want to stress that, but it does become a consideration as you take a look at when to claim benefits if you're fully gainfully employed and just looking to tap another income source. So one other thing that as planners we get asked about quite a bit is taxation of benefits with regards to Social Security. When we talk about taxation, the first thing to state is the calculation for tax consequences around Social Security really hasn't changed. It's the same as it was last year, even though there's a lot of buzz about the one big beautiful bill and the passage of the act and some things to point out. The calculation itself has not changed. It starts with provisional income. Provisional income is what we classify as the income by which we compare it against thresholds. And that's defined by taking your adjusted gross income plus your tax exempt interest and half your Social Security benefit. You take those, that makes up your provisional income. Then you compare it against your filing status to determine the amount of Social Security benefit that could potentially be exposed to tax consequences. If you're single and you're below 25,000 or married filing jointly and below 32,000 with that provisional income, then none of your Social Security is affected or exposed to taxation. Between 25 and 34 if you're single, or 32 and 44 if you're married filing jointly, up to 50% of your benefit could be exposed to taxation. Over and above that, up to 85% gets exposed to benefits in taxation. So over 34 and 44, once again, 85% of that benefit becomes taxable. The big game changer, however, was around the one big beautiful bill and the passage of it, which really essentially layered in another standard deduction for seniors. So if you're over 65, you now have an additional $6,000 senior deduction that gets tacked on top of the already existing senior deduction, which was there, plus the standard deduction. And that's why you see the top line here, 90% of retirees won't pay tax on Social Security. I know there was a lot of buzz around the fact that we're going to eliminate taxes for Social Security, but the reality is they didn't eliminate the taxation, what they did is they just added additional deductions for it. So that's really important to understand. But 90% of taxpayers should be shielded from it. Taxation for federal level, we've covered, but there are 9 states, I believe, that are still taxing Social Security. There's some exemption amounts. That does seem to be changing, where less and less states are taxing that benefit as well, but just something to keep in mind. So, Jeff, we've talked quite a bit about claiming and different types of strategies. We're going to get into some of the questions that were submitted, but I can't help ignoring the 800-pound gorilla sitting in the corner, which is this solvency issue that Social Security is facing, particularly around the core trust fund for old age and survivor benefits. The CBO, the Congressional Budget Office, just released their 10-year outlook, and it's got those funds being depleted in early 2030s. Do you have any thoughts on what might happen and what you might see here?
Yes, and I foresee action being taken. And I'm just gonna, going along with your point, yeah, the trust fund is facing depletion by about 2033 to 2034. We're about 77 about to 80% of benefits would be payable. But again, I foresee legislative action being taken moving forward. It's been done in the past. Many of these variables have already been tweaked, so I anticipate more changes will come. Now, the changes that could come or proposals, things that could be adjusted, would first be raising the Social Security wage base. Now, I mentioned previously it's currently at 184,500 for 2026. Bumping this number up would generate more tax revenue and subject more earnings to payroll tax. That's the first strategy. Second could be pushing out the full retirement age. Full retirement age, as I mentioned, is age 67 for many. If we push that out a couple of years, it might delay the amount of retirees pulling from the system and sort of minimize that. That's another way we could go about maintaining and sustaining the trust fund. Mm-hmm. Another option could be increasing payroll tax. So when, of course, we get our paycheck and that 6.2% is pulled out, maybe increasing that, and that in turn would fund the trust fund more. Lastly, a push to have 100% of your benefits included in your taxable income could be made, again, generating more tax revenue. You saw Mark shared that previous slide pertaining to provisional income, so that's where that is applicable as well.
Yeah, some interesting discussions taking place in Capitol Hill, and it's going to be something that has to be taken care of. Otherwise, you could see some benefits cut, and we certainly don't want to see that. I know a lot of people depend on it. The wage base is interesting too. When you think about it, only going up to 184,000, I know there's been a lot of talk about maybe moving that up. The other thing that we saw come about in a proposal last year, I don't think it's got a lot of legs, but the idea of really carving out a separate sovereign wealth fund. Senators Cassidy and Keene, in a bipartisan proposal, suggested the idea of carving this out and establishing a $1.5 trillion fund that is essentially outside of the scope of the existing trust fund and invested a little differently, taking into account some investment-oriented market returns. So we'll have to see how this plays out. A lot more needs to take place. We don't have all the answers, no crystal ball. But I'd like to jump into some Q&A here since we're at the 12:30 mark here. We got a lot of questions that were submitted as part of the registration process. One of them that I thought was a really good one that kind of speaks to maybe what happens when you have multiple benefits coming in from different places. Jeff, can you talk just a little bit about the interaction of maybe Social Security retirement benefits, and if you have a disabled adult child benefits and family maximums and things like that?
Yeah, sure. So the disabled adult child benefits are generally going to be up to 50% of that worker's PIA. So it's really an adult child collecting on behalf of the worker.
Mhm.
And again, it's going to be 50% of that PIA number. Again, the PIA where it's based off everything,
Primary
right?
insurance
That's
amount.
where all the
Right.
numbers come from.
It's an important
Uh,
one. Yeah.
yeah, exactly. And so for the benefit to actually be paid, though, the worker needs to collect their Social Security benefit. So once that happens, then the DAC benefits would be paid, and then you'd consider what the family maximum might be there. Now, a couple other requirements really for that child, though. Of course, they need to be disabled before 22. Of course, the adult or the worker needs to be collecting Social Security. The adult child cannot get remarried. So there are a couple stipulations there. And Mark, to your point previously, they need to, satisfy that Social Security requirement of, being able to perform a gainful activity. So that's another consideration there.
Yeah. Really good commentary around that. So one that we got that kind of ties in with the fact that you have to have both be filing. We get a lot of questions around spousal benefits, and particularly when somebody has lesser lifetime earnings than another higher income wage earner. Um, what does that look like? And when how does it work if there's survivor benefits that ultimately would be in consideration after that?
So I would say that the higher there's a couple ways you can go about it. So we'll start spousal benefits. The max the I guess the lesser earning spouse would receive would be 50% of the primary insurance amount. So what happens is, say at age 67, they are eligible for a lower benefit. They first file and they actually receive their benefit first, believe it or not. And then
Yep.
they are actually like capped up to that 50% number. And now that's
Yep.
only if they take it at their full retirement age. So
And Jeff, to
it's
that point,
interesting.
I did want to hit on that because we used to have file and suspend, which is something that you had talked about and alluded to earlier, and that's not the
Mhm.
case anymore.
Yep. Yeah, exactly. No, that's not the case anymore. So you're filing for your benefits. Um, they stick around. You actually can still suspend. However, if you suspend, it cuts off the spousal benefits now. So that's really the feature that used to be helpful. You could turn it on, turn yours off, and then the spouse could benefit until
Right.
you begin
It's
collecting your
just
retirement
not the
benefits.
strategy that used to be pushed before. So, yeah.
Exactly. Yes.
Um, so just to clarify though, for people, so you mentioned 50%, that would be compared to a lower income wage earners record on their own credits and their benefit. You're not going to get both.
Exactly. You're not going to get both. Basically, you'll get if they're eligible for benefits, they'll get them, but then they get topped up to a spousal boost is the key term there. So,
To
but
get
the
them up to the
maximum they
50% of the
exactly,
work.
exactly.
Gotcha.
Well
Okay.
said.
And then the survivor benefits we should touch on because that has to be a
Of
consideration,
course.
especially as we factor in health.
Yep. The survivor benefits are interesting, and this could actually be a good case if we have maybe an older spouse who happens to be a male, and then a younger spouse. Maybe well, we all know men don't live as long as women, and so in a I guess a theoretical strategy, the older spouse could delay a couple extra years, and we know that he gets that 8% increase each year, and believe it or not, when that spouse passes away, the younger spouse actually gets that age 70 benefit, which
Mhm.
is really great. And that's a really popular strategy, especially when there's a spouse who's a couple years older. Those survivor benefits, they benefit from that permanent increase if you delay.
Yeah, which can be really significant to your point. So a couple other questions we had. Is there a better month to start your Social Security benefit, beginning year, mid-year, year end?
No, there isn't. It's really a matter of how much your benefit is reduced or increased. The reductions and the increases are done on a monthly basis. So I'll just again, if we break down, let's say we take at age 62, that first 36 months, you essentially have a 5/9 of 1% decrease each month, and then 5/12 of 1% for the next 36. So, if you collected in June versus July, that's just a percentage of a percentage decrease essentially each month. It's not like, you get more if you take it earlier or, uh, you know, I see where, taking it during different times of the year might raise that question.
Yeah. So the overarching question is optimal age for taking, Social Security benefits and when to wait on it. I have thoughts around it, but I'd love to hear yours first.
Yeah, I hate to say, but it depends.
It really does.
Yeah, everyone on the webinar knew I was going to say that. However, it's really first a question of when do you want to retire? When you retire, you're not going to have income. So, when do you want to retire? And then really the second question is, do you need the income? And then really sort of along with when you want to retire and sort of other life events, how do you foresee your longevity? Do you plan on living until age 80 where you can potentially benefit from delaying your benefits? Or maybe you only anticipate you're going to live to 75 and it makes more sense for you to take your Social Security benefits early. Another point, Mark, we mentioned the survivor benefits with an older spouse who was a higher wage earner. That's another strategy and consideration if, to delay benefits. Maybe the spouse is going to rely on that higher income after their spouse passes away for, again, healthcare expenses, et cetera. So I guess to say the least, there are a ton of considerations that are on the table when you're considering Social Security. And of course, timing is everything. And it's a decision you want to really think about and strategize around.
Yeah, absolutely. Couldn't agree more. A couple things I might add to that. You certainly have to take a look at your own personal goals, health situation, income. Are you going to be working during retirement as a consideration? Also, your risk tolerance. We find that some individuals are looking at guaranteed income and more conservative cash flow versus investing in market returns, because you'll see some publications and advisors that might be out there in the marketplace pushing strategies where you do are able to essentially get the benefits today, invest those in time value of money, and all that's well and good if you're comfortable with the investment risk that is assumed there. As Jeff said, it is a planning discussion. I would encourage you to certainly reach out to your advisor at Bryn Mawr or whoever you're working with to evaluate your options and take a look at your personal situation, because it is personal. It's not one size fits all. I want to leave you with the fact that it is all about financial planning, looking at the bigger picture. I want to thank all of you for being here and joining our webinar today. Hopefully we addressed a lot of your questions. If you have additional ones that we didn't get to, by all means, reach out to myself or Jeff or your advisor at Bryn Mawr. And thank you for attending.
Thank you.